For this week's company, we're going to have a look at Sweco, which is a Swedish architecture and engineering consultancy company and one of the biggest in Europe. They mainly operate in the northern parts of Europe, say the UK, Sweden, Finland, the Netherlands, etc. Usually when we look at construction companies, we see terrible margins and a lot of share dilution. But Sweco is not a construction company, they are a consultancy company. So let's have a look exactly what they did for the past 10 years. Let's have a look at their financials and let's see whether or not we think if we buy the stock today and hold it for a decade, can we outperform the market? So looking over here at their revenue numbers, we can see a very steady increase of 11.5% here for the past 10 years. We do see a slight blimp in 2020-2021, which was of course during the COVID pandemic and most people were quarantined and therefore of course construction was very much halted, which also impacted Sweco's top line and also their bottom line. But nevertheless, they see a consistent 11% annual growth here for the past 10 years, which is incredible for any company to have double-digit growth, especially for a consultancy company like Sweco. We also see their EBITDA, so their earnings before interest, taxes, depreciation and amortization increase in line with their revenue with about 12%. We see therefore a consistent margin of around 10% of their revenue or net sales as presented in their annual reports. Overall, we also see a relatively steady debt level here for the past 10 years, growing by only 1.6% annually. Of course, they do see a higher debt load here in 2018-2020, but they already very much bought back the debt that they had. We also see some additional cash on their balance sheet to cushion any additional blows. Their market cap, so the price on the open market itself, has grown by 14.5% annually for the past 10 years. And this does of course not include the dividends. The dividends are on top of their market cap. And Sweco aims to pay out about 50% of their earnings in dividends. So I think that's definitely an attractive dividend to have on top of this incredible revenue and EBITDA growth here. Enterprise value is the entire value of the business. So we take the price on the open market itself, so the market cap, to which we then add the debt and we subtract the cash. Debt and cash are basically negligible in the grand scheme of things. So that's why we also see an enterprise value growing about in line with their market cap. EV/EBITDA ratio is quite high here, I do have to say, for any European company, but of course it's no wonder considering the fact that they're growing their revenue and their earnings by double digits annually. We see an average multiple here of 17.4 times, which means that it takes Sweco about 17.5 years of EBITDA to buy back the entirety of their enterprise value. We definitely see higher points here of 27 times in 2020, and we also see a low point of 11 times in 2014. Overall though, the average number is 17.4. The moment that we look at that net debt to EBITDA ratio, we see a very nice trend which is steadily decreasing in multiple. We see a 1.7 times multiple in 2013 and we only see a 0.4 times multiple in 2022, which means that Sweco is very underleveraged. If they want, they can take on a lot of debt and they can easily afford it. They have, however, chosen not to do this and they have chosen to actively buy back their debt numbers, so they are a very safe and secure stock to hold and there's no risk of bankruptcy for Sweco anytime in the near future. So moving over to their cash flow here, we can see a very steadily increasing cash flow from operations from around 500 million Swedish krona to about 2.5 billion. Capital expenditure has increased from 93 to 274 because there is not that much property or plans to actually buy. They are a consultancy company. They don't buy the equipment, they don't buy the machinery. They provide the planning and they provide the frameworks for it. So therefore we see a very low capital expenditure, which means that the margins for Sweco are relatively high. The moment that we take their free cash flow and we subtract the capital expenditure, we get the free cash flow, which is basically your pro rata ownership of the company. This is all the money that's available to you at the end of the fiscal year and is able to be distributed either in the way of expanding the business, buying back debt, issuing a dividend or buying back stock. And in the past 10 years we have seen Sweco make additional acquisitions, we have seen them issue a consistent dividend and we have seen them buying back debt. We have not yet seen them buy back their share count, but I can't imagine that they might contemplate doing this because their debt level is so low and they do have the additional money to spend here. Looking at their shares outstanding, we can see that they've increased their outstanding shares in 2014, 2013, heavily diluting their shareholders here between 2014, 2015. But the moment that we look over at their revenue, we also see that this definitely has paid off. They had a massive revenue spike here because of an acquisition that they made. So I think them diluting their share count here is not a problem at all, considering the massive growth that they had because of it. The free cash flow per share is what you get when you take that free cash flow and you divide it by the amount of shares outstanding. And this number has been steadily growing by 16% here for the past 10 years. Of course, it does say the dollar mark here, but do keep in mind that we're not talking dollars here, we're talking Swedish krona, which is equal to about 10 cents in dollars or about 9 cents in euros. So do keep this in mind. The valuation of the currency is a lot lower compared to the dollar or the euro. The price in Swedish krona per share has increased from about 34 Swedish krona in 2013 all the way to 100 Swedish krona in 2022, which is still a massive drop from the high of 170 Swedish krona that we have seen for Sweco in 2021. Currently their share price is way down, even though their fundamentals are actually not impacted all that much in the grand scheme of things. So I think this might definitely provide an interesting opportunity for us, but we'll get to that later on in our projection. Overall, their free cash flow yield is about 5% annually, where we definitely see that 2022 was a bit higher than that. So we can expect this free cash flow yield to come down here, increasing our stock price valuation. So let's try to forecast Sweco here into the future. So they've been steadily increasing their EBITDA by about 12% annually, which is an insane growth for any company, and it's definitely very nice to see. For my projections, however, I do want to be a bit more conservative, and the moment that my conservative estimate beats the stock market, that's when I'm going to be interested in buying the stock. And therefore, for Sweco, I'm going to give them 10% here for the first year, 2023, and then I'm going to reduce it to 8% for the 4 following years, and then 6% for the last 5 years, which is definitely a very conservative estimate, right? Overall inflation growth is about 2%, so I do definitely expect Sweco to still grow their operations. I just don't expect them to grow as fast as they have been doing here in the past 10 years, because they saw a massive growth here because of the acquisition that they made, and overall their trend line of growth is around the 8 to 12% annually. So therefore I'm also going to give them 10% here, and I'm going to reduce it to a lower single digit number. I'm going to attach a multiple here of 18 times EBITDA. Historically they've been trading at 17.4 times. I do think it can come up a little bit more. I'm going to give them 18 times. This gives us an enterprise value of 89 billion, from which we then subtract the debt, we add the cash, giving us a market cap of 88 billion Swedish krona. Divide this by the amount of shares outstanding, and I'm assuming here that the amount of shares outstanding remain the same. This gives me a stock price 10 years from now, so in 2032, of 246 Swedish krona. So for free cash flow, overall for the past 10 years, they have been growing it by 18, even 19% here for the past 10 years, which is insane, and mostly influenced by the fact that their first year was actually quite low. So I don't expect them to reach this percentage annually, but I definitely expect them to come somewhat close. I'm going to give them 15% here for the next year, and then I'm going to reduce it to 12% for the next 4 years, and then to 10% for the last 5 years, which is still double-digit growth, which is amazing for any company. And even though it might be more on the conservative side, I definitely think that 19% annually is a bit optimistic looking into the future here. I'm also going to attach a yield of 5%, which is about their average for the past 10 years. And this gives me a stock price 10 years from now for Sweco of 363 Swedish krona. So right now on the open market, I can buy as many shares of Sweco as I want for 110 Swedish krona. Given both my projections, so the enterprise value as well as the free cash flow method, I get an average share price 10 years from now of 305 Swedish krona per share. Just simply looking at the return on the open market itself, so just looking at the actual stock price, I expect Sweco to give me a compounding annual growth rate of 10.7%. But the moment that we include all the free cash flow that we expect to receive from Sweco, as projected here in our free cash flow model, I expect an IRR of 20.2%, because of course they can use the free cash flow that they're making to issue a dividend which is not included in the share price. They can make additional acquisitions, they can buy back more debt, or they can buy back stock, which is of course also increasing your return, and therefore we see the IRR number being higher than their compounding annual growth rate number. Overall, I always say that the stock market returns about 10% IRR, so given my relatively conservative estimates, I still think that Sweco is an amazing buy right now, given that it's trading at a discount compared to, last year when it was trading at 170 Swedish krona. Right now it's trading at 110 Swedish krona, even though their earnings have gone up, their cash flow has gone up. So I definitely think the drop is a bit too extreme given the circumstances. But let's see what happens if the price goes up or comes down a little bit. So the moment that the price goes down by 30%, I expect an IRR of about 27%. The moment that Sweco comes back to the 80 Swedish krona range, which I actually don't expect it ever will again. But just in case it does, do know that the IRR, so the return on your investment, is absolutely immense. The moment that the price comes up again to about 140 Swedish krona, I still expect an IRR of 15.7%, which is still outperforming the market, and I think I would still be interested in buying the stock. Right now though, I can buy it for 110 Swedish krona, which I think is definitely attractive. And if you're still looking for an engineering or like a consultancy company for your portfolio, I would definitely advise you to have a look at Sweco. Thank you very much for watching. Don't forget to like, subscribe and all that good stuff, and I'll see you in the next one. Cheerio.